Good morning, everybody, and welcome for attending the BetaShares webinar for today, Opportunities in Global Equities. Really excited so many of you advisors have decided to join us to talk about this topic. Obviously a very interesting time in markets, and certainly an area we're seeing a lot more interest in terms of global equities itself. Quick disclaimer there, you'd all be familiar with. This information is not personal advice. It should be considered general advice only. Just a couple of key points. As you guys would know, whoever has attended this before, you will be aware that there is a recording of this webinar that has been made and will be sent around to all attendees who are registered. Any questions you have throughout the time of our webinar, please do fill in your question via a message, and we will endeavor to respond wherever we can. Today, I'm joined by Peter Harper. Peter has been involved in many webinars with us. He's the co-head of sales here at BetaShares, responsible for leading the sales strategy across a number of client segments. He is also head of our capital markets desk, and he'll be taking us through the opportunities we see in global equities at the moment. And before we do that, we'll just use a bit of an interactive tool to get a sense of people's views on global equities. So the first question I'm going to ask is, what percentage of your clients' portfolios are currently allocated to global equities? So you can just fill in the response there, and I'll share those in just a second. So it looks like we've got enough people here. Let's just have a look at what that was. Apologies, that was, there it is there. So the responses there are pretty even, but it seems like most of you have either 0 to 25% or 25 to 50%. And for the next question, how do you expect that to change? So do you expect your clients' allocation in global equities to increase, decrease, or stay the same? And just let those come through. And I'll share that across the team. And yeah, so it looks like that again is more clear. It seems like people are expecting their allocations to, well, nobody's really expecting it to decrease. There's about 30% of people who expect the allocations to increase, and around 65 or 63% to remain the same. So without any further ado, I will now just attempt to share the screen. Apologies. Give me 1 second. Sorry about the slight technical difficulty here, and pass on to Peter Harper to talk us through the opportunities in global equities. Peter, over to you.
Thank you very much, Alan, and thank you everyone for joining us today to discuss the opportunities in global equities. First of all, there's a couple of things just to consider, or that we will consider over the course of today's webinar. And the first is, why consider global equities? And there are three things that we think stand out. First of all, there's a world of opportunities available around the globe that do not exist in Australia. Secondly, investing offshore can help avoid home country bias. And thirdly, clients are demanding more exposure to international equities by and large, so it can help an advisor meet client demand. When we look at the opportunities in global equities, there are a few things that stand out to us. The first is the opportunity to invest for income in global equities, investing in quality, investing in disruption, and defensive global investing. And we'll cover each of these as we go through today. Why consider global equities for an Aussie investor? There are a number of benefits, but Essentially what it comes back to is diversification and opportunities. Certainly, we've seen the end of the mining boom in Australia, which has meant the environment has been more challenged. It may have come off its cyclical lows, but it's been more challenged for the resources market. We're seeing slower credit growth and potentially some challenges in the housing market in Australia, which may be difficult for the financial and banking sector. And those two make up a very large chunk of what you get in Australia. There's also very little exposure to many global sectors within the Australian market. And if you think about some of those, probably technology and agriculture might stand out as a couple of those. Australian businesses are also facing increased competition from global competitors and innovators who are looking to expand their global footprint into the Australian market. And probably the final thing is that historically it's been challenging or costly to invest in global equities, but now with the very broad range of ETFs available, investors can do so in a very simple, diversified and low-cost manner. So what is the world of opportunity available? Well, Australia accounts for only 2.3% of world share market capitalisation. So I would suggest that if you're only directing your investments towards 2.3% of the opportunity, you might struggle to find the best opportunities available. To put this in an Aussie context, imagine if you tried to build an Australian share portfolio considering only 2.3% of the market cap of the Aussie market. I would put it to you that would make it very difficult to build an optimal portfolio. And now that we're in the age of global investing and asset allocation, I would encourage you to think about global equities in the same manner. To remain only invested in Australia reduces your diversification and significantly curtails the opportunities available to you to invest in quality companies. Just as an example here, I mean, we can see the weightings of the NASDAQ 100 index by sector on the left and the S&P ASX 200 on the right. What you'll notice in the ASX 200 is heavy weightings towards financials and materials, those two being the stalwarts of the Aussie economy over the last few decades. Some of those industries may face further challenges into the future, as we discussed. If you look and compare those weightings in those two sectors and to what they are in the NASDAQ index, you'll see they have a 0 weighting in the NASDAQ index. What does NASDAQ have exposure to? It has exposure to opportunities such as technology, cybersecurity, healthcare and agriculture, or globally there are those opportunities, that don't necessarily exist in the Aussie market. So think about a company like Amazon. That's a consumer discretionary business. And that sector makes up 22% of the NASDAQ index versus only 4.8% of the ASX 200. Think of companies like Google, Facebook, Microsoft. Those businesses and that sector make up 60% of the NASDAQ index, but only 2.3% of the ASX 200. So there's a significant opportunity to invest into some of the broader opportunities globally, and at the same time to add diversification to Australian portfolios via investing internationally. Avoiding the home country bias. Look, I think we've probably largely covered this, but I mean, as we said, home country bias is like fishing in a tiny pond when the whole ocean beckons. What it is the tendency to invest predominantly in local companies. And why do people do that? Well, it's understandable in that they're investing often locally because they know those businesses or are more familiar with local businesses than they are with what's offshore. But that needn't, in this day and age, be a reason not to go offshore. The advent of investments such as ETFs mean offshore exposure can be garnered as simply as buying BHP or CBA on the ASX. It can be done with instant diversification to a broad portfolio in a single trade, and can provide access to many of those growth opportunities not available in the Australian market. We discussed the fact that there's a growing demand from end investors for international equity exposure. And this chart shows the top 15 international stocks by trading value for SMSFs. And what you'll notice is that there's a fairly heavy bias towards both tech and Asian businesses. And buying of direct equities from SMSFs internationally has actually jumped 57% over the last year. ETFs make it easy to do this in a more simple, diversified manner, as I've stated. What are the main reasons advisors are using ETFs? Well, we know from research that the top 3 reasons advisors are using ETFs are low cost, diversification, and access to specific overseas markets. So international equity investment or international market investment is one of the key reasons ETFs have been supported in the advisor and investor community. If we look at some of the real flows going into international equities year to date, up to 30 September, they remain very strong and very tilted towards international equity exposure. So far, year to date, to 30 Sep, we've seen about $2 billion flow into international equities, international equity ETFs, making that the highest area of inflows across the market. In fact, the flows to international equities are about 2 times the next biggest asset class for inflows, which is fixed income. Let's now take a look at some of the more specific opportunities available in international equities. There are 4 key thematics that I'm going to cover off on today. The first is investing for income. The second, investing in quality. The third, investing in disruption. And the fourth is defensive global investing. Let's move on to income now. When investing for income, BetaShares has recently launched the BetaShares Global Income Leaders ETF. As I'm sure you're probably well aware, one of the key hurdles to international investment for Australian investors has been the historical reduction in income or dividend stream from global shares relative to Australian shares. But as we're going to see, that need not be the case. And the Global Income Leaders ETF, ticker INCM, holds the 100 highest yielding global and mid-cap companies. You can see some of the names there, things like Verizon, Lazard, Singtel, companies with which you and your clients are probably well familiar. This exposure is also available at a competitive management fee of 45 basis points. And particularly given some of the volatility we've seen in markets and some of the swings we've seen in markets recently, I'd probably point out as well that this exposure has a little bit of a value tilt towards it relative to broad market equities. And we have seen a bit of a switch out of growth into value from investors internationally over the last couple of weeks. So let's have a look at how the index actually selects its stocks. The starting point for the index selection is the eligible universe. And that universe is developed market global shares ex-Australia of both a large and mid-cap variety. Now, I think the inclusion of mid-caps is actually important here because particularly if we see an escalation in trade wars globally, having exposure to mid-cap stocks, which may be more focused on the domestic economies within each of their regions, could help mitigate some of that risk. The stocks are then screened for dividend sustainability factors. And those factors are the persistency of their dividend. They must have paid a regular dividend for the last 3 years. the payout ratio of the business must not be excessive. The business must be profitable, and the business must have a low volatility. Those factors are there to guide the sustainability of the dividend stream of the companies selected. Those companies are then weighted by yield, and we apply country and region weights in line with broad global benchmarks to make sure we're not ending up with a portfolio that's overly tilted towards any part of the world relative to a broad global benchmark. The outcomes are a portfolio that yields 5.2% on a gross basis relative to MSCI World at 2.4%. So very strong gross levels of income. I would make the point very strongly, however, and this is something all advisors should be aware of, when investing internationally in any exposure, whether via direct equities, managed funds, ETFs, you will often find that investment is subject to withholdings tax. After deducting withholdings tax, that reduces the income level on INCM to a net yield of 4.5% compared to MSCI World at 2.3%. Nonetheless, a fairly high level of income, and I would suggest this covers off on a major hurdle preventing many investors seeking offshore diversification, in that it mitigates the historical requirement to forego income when diversifying offshore relative to an Australian portfolio. Additionally, historically, this sort of portfolio with added income has not come at the expense of performance. You can see there the grey line showing INCM's index going back bit over 10 years to March 2007 compared to MSCI World. And you can see there that INCM has in fact outperformed MSCI World over that period. So that's the income element of proceedings that we wanted to cover. We also think there's an opportunity to look at investing in quality. And this week, BetaShares has launched the Global Quality Leaders ETF. Ticker for this one is QLTY. It holds 150 stocks and is at a competitive MER of 35 basis points. That's cheaper than any other quality exposure in the market. So what are quality companies? Well, the rationale for quality is simple. It's to come up with an index consisting of stocks that have, firstly, a high ROE. Secondly, that ROE, as we will see in a moment, needs to be sustainable. It's not good enough to have an ROE that's high in the short run, but not over the long run. And we're looking to harvest a factor premium with a diversification benefit. So QLT's index, as we said, focuses on high sustainable ROE. So what are the three factors that lead historically to a sustainable and high return on equity? The first is financial health, a low financial leverage or debt to total capital ratio. The second is profitability, the ability to generate high levels of cash flow and profitability. And the third is business stability, which is accompanied with low earnings variability. Those three factors have historically led to high returns on equity into the future. Let's now look at why quality and high sustainable ROE is important. What you'll see here is at the bottom a grey line, which is companies that had a high ROE but did not sustain that ROE over the long run. Compared in red to companies that had a high ROE and were able to sustain that over the long run. And you will see the cumulative performance for high sustainable return on equity is very significant. It's also significant when considered against other broad market and quality indices since inception. You can see here the index tracked by QLTY in orange, shown against the MSCI World Quality Index in grey, and just the broader MSCI World Index in blue. And you can see that historically, QLTY's index has delivered around 2.5% outperformance versus MSCI World since inception. The other important factor historically is that quality exposures have demonstrated defensive characteristics during market declines. The blue shading here shows the drawdown of the MSCI World Index from January 03 through to October 2018, with the maximum drawdown being 42%. The orange drawdown or shading shows the drawdown in QLTY's index with a maximum drawdown over that period of 23%. So historically, quality has helped reduce drawdown over that period in difficult market environments. I now want to move on to the third opportunity in international equities, and that is investing in disruption. And there are two key areas we want to touch on here: global robotics and Asian technology and internet retailing tigers. So why consider robotics and AI as a thematic? Well, there's three key reasons in my view. The first is aging populations. You can probably read many articles out there in the press that talk about fear of robotics taking over people's jobs. I'm going to argue that almost the opposite is true. Statistically, it looks likely that the proportion of non-working to working adults in the population will almost double over the next couple of decades. So far from robots replacing humans who want a job, it's almost going to be a fact of we need robots to replace the lost human workforce and keep GDP and productivity running. Without them, it's unlikely that we will have enough human capital to be able to maintain levels of production and growth within the economy. Labour costs. Scarcity of labour into the future could well lead to higher wage pressures, and the introduction of robotics and AI may help alleviate some of those inflationary pressures in the economy. And thirdly, there's the idea of performance improvements. The fact of the matter is, in many areas, robots are starting to deliver superior and more efficient outcomes than what humans can deliver. And one of the areas that this is in play is actually in surgery. Robotics used in surgery are providing much more pinpoint results than accurate results than a human could ever provide. So it's leading to improved quality and higher output. All of these thematics are encapsulated in the BetaShares Global Robotics and Artificial Intelligence ETF, ticker RBTZ, or as we like to refer to it, robots. This trades on an MER of 57 basis points per annum, which is about 25 basis points cheaper per annum than other robotics exposures available in the Aussie market. What are you getting within RBTZ? Well, you're getting an exposure to a broad spectrum of robotics and AI thematics. We're talking everything from industrial robotics through to non-industrial robots, that's things like agriculture and healthcare, autonomous vehicles and drones, and artificial intelligence. So a broad range of robotics AI exposures. Here are some of the major names that the index has exposure to. Although I'll let you, you can easily go on the website to see the full list there. The other disruption factor I wanted to touch on was around Asian technology and internet retailing tigers. Asia is now home to 4 of the 10 largest global tech companies. And that, I'm sure you'll agree, is a fairly significant proportion of global tech. Additionally, e-commerce spending in Asia is already very significant and is likely to grow faster. So a company such as Alibaba already has total sales that exceed the combined sales of Amazon and Walmart. Quite a startling figure. But that's expected to grow very quickly. So at 2018, we're looking at e-commerce spending of about 13 billion projected for this year in Southeast Asia. That's expected to rise over the next 7 years to 2025 to about 88 billion of e-commerce. So what are some of the benefits that an exposure such as Asia can provide? Well, first of all, it allows you to invest in the technology giants of Asia that aren't readily available. Secondly, it allows you to take advantage of what I think is a fairly significant growth opportunity. I just want to give you some comparisons between Asian technology adoption and US technology adoption. Currently, the rate of online shopping in Asia, as I mentioned, is 2 times the rate of online shopping in the US market. So very, very strong adoption in the early stages for online retailing and online presence. That said, in the US, 90% of the population has access and utilizes the internet. If you go over to Asia, only 50% of the population in China has access to and utilizes the internet. So I think there's a very significant opportunity for additional uptake of internet usage in Asia relative to other developed markets in the world, which may help boost growth very substantially. On top of that, Asian technology and internet retailing tigers are trading on a PE of around 11 times on a 1-year forward basis. That's a significant discount to the S&P Technology Index. There's also added diversification, and there's actually quite low correlation between Asian technology and that of the S&P Technology Index. So the thematic, as I said, is available through the BetaShares Asian Technology Tigers ETF, ticker ASIA, Asia, available for 67 basis points on the ASX. Some of the businesses that this exposure invests in, you would have undoubtedly heard of. Groups like Alibaba, and I mentioned just how large their sales and profits have grown relative to Walmart and Amazon. Tencent, one of the real leaders in the Asian technology space, Baidu, and JD.com. You can see some more detail on each of those companies, but in the interest of time, I'll let you read that in your own time. The final opportunity I wanted to touch on in global equities is that of defensive global investing. I think it's important to consider defensive exposures, particularly given recent volatility that we have seen in the market. For a long while now, BetaShares has had a number of funds within what we call our managed risk suite of products. And these products own physical underlying securities, but overlay that with a professional risk management strategy delivered by Milliman, one of the world's largest actuarial and risk management businesses. Milliman has been operating this strategy for many of the world's largest insurers since the tech bubble, and it actually protected insurers' portfolios through the tech bubble and the GFC. So a very tried and tested risk management overlay. The way that overlay works is to maintain exposure at all times to the basket of stocks, but to eliminate some market risk via short futures positions at times when volatility rises above market averages. The ticker for this exposure is WRLD. So it has an objective to provide broadly diversified portfolio exposure to global shares, but to reduce the volatility of equity investment and cushion downside risks. All available for 54 basis points. The historical track record of managed risk exposures over the long term has been strong. If you compare the returns going back to 2000 of WRLD versus MSCI World, you'll see they've both delivered the same annual return over that period of 4.5%. But the risk managed strategy has delivered that same return at a lower volatility, much lower volatility, in fact, of 8.1% versus 15.7% for MSCI World. So what that means is that it has delivered a much higher risk-adjusted return for investors. You'll also see on the chart the defensive characteristics of a managed risk exposure, both through the tech wreck period of 2001 and through the GFC period of 2008, and see how well managed risk exposures held up. That's all I wanted to cover off on today. Please stay informed with BetaShares. Visit our website. If you're not signed up to our blog, you can certainly receive regular economic insights from our Chief Economist, David Bassanese, and follow us on social media. We are here to help wherever we can and publish regular content that we think advisors will find useful.
Thank you so much, Peter, and thank you all for your attendance. We'll probably just have time for 2 questions. Did want to make sure that we keep these tight, given the busy time of year that everyone is having. I did want to also mention that we do have our handouts here. On the handout section of your widget, you'll see some information on the 4 funds that Peter had mentioned. Of course, our website has a lot more, but that's some basic information. There's been a few questions about CPD points. We do offer CPD points for this particular webinar, and those will be sent out at its completion. Look, 2 questions from the audience, Pete. One is just about the INCM fund and the topic of country exposures. How those country exposures might change if we're focusing on income-oriented stocks. Would it not be heavily exposed to places other than the US?
Yeah. So if you look at look, I'm speaking fairly generically here, but if you were to look at a MSCI World style country weighting, it's going to be approximately 50-odd% to the US market, with Europe and Japan making up other significant parts of that exposure. Now, one of the things we've endeavoured to do within INCM is to make sure that we do not end up with a country and region allocation that is significantly different from a MSCI World style benchmark as a result of trying to select higher income stocks. So the strategy itself, as part of the index methodology, looks to adjust weightings within the portfolio to try and keep them broadly in line with diversified global benchmarks. So as a result of that, you should not see instances where the country and region allocations of INCM differ materially from those global benchmarks.
All right, well, that's great. Look, I think we'll leave it there. We thank you all very much for your attendance. As I mentioned, a recording of this webinar will be sent to you all at the conclusion, as will the CPD points. Please feel free to get back to your BetaShares client services representative with any questions or queries, or respond to us via email. Thank you all very much for your time, and we'll speak to you again shortly. Thanks again.